Evening, ladies and gents. It is Simon Brown here. I'm kind of doing this evening's presentation, but I'm not the main attraction here at all. I'm joined by Anthony Clark, who is the sort of the small cap guru in South Africa. We were just chatting. He's been doing this for literally for decades, and that's not saying he's old. It's saying he's deeply experienced in the process. What we're going to do is up front, we'll talk a little bit around what we've seen sort of post-pandemic results coming through. We're going to dive into different stocks. It's going to be a conversation with me and Anthony and questions. You got questions, drop them into the Q&A. I'll be right up front, straight with you. We're not going to get to some of your questions because A, we're going to have a ton, and B, they're just some stocks that Anthony doesn't cover. Kibo is one of them. You're going to ask what's happening. He doesn't cover it. He can't have a view. He can't make up stuff. So there will be spaces where we just we don't have an opinion on that. So we'll stick to sort of his wheelhouse for want of a phrase. Anthony, always appreciate the time. I suppose let's kick off. And I mean, we're in the heart of results season right now. And I got to say, the results coming through broadly across the board are mostly fairly good. There's some exceptions. We've seen good numbers. And I appreciate some of it is base effect because we're comparing to during the pandemic. But even if you remove that out of the equation, a bunch of stocks in your universe are frankly coming out of this pandemic stronger than they went in.
Yeah, hi Simon, it's very good to be here again, and to all the listeners online. Yeah, right, we're in the thick of reporting season right now, and as we were discussing before we came on air, it is a frantic period with many clashes and back-to-back presentations. But you're right, the pandemic, despite all the doom and pessimism it caused to the underlying consumer and all of us stuck at home, many corporates, particularly in the small to mid-cap space, use that time to basically restructure, cut costs, become leaner and meaner, and many came out of the pandemic, as I would call it, with spikes on. They were basically running to play catch up, and they'd restructured their business to such an extent that, as the economy reopened and consumers started spending again and industry started moving, they were really running quite hard. But that base effect, as you correctly say, is now in the system. And I think an example of that we saw today was Cashbuild. They came up with very disappointing numbers. Not that they were disappointing, it's just that last year's number was so extraordinarily high, with a huge special dividend, that they only had one way to go, which was down. The DIY boom from the pandemic is over, and companies which had benefited from that are now all beginning to slow down. So Cashbuild has seen a significant derating, and they have more to come. But as you correctly say, many of the small to mid caps have come out with particularly good earnings. In fact, in many cases, I liken it to the fact that the market wasn't expecting this. But if you cover the sector as closely as we do, and we discuss it with management and we kick the tires, you can see many of these results coming from a mile off. But the market being the market, they only actually react to share prices and results when they see a headline in the business day or on some form of financial media, Bloomberg, Reuters, INET, etc., etc. So all in all, the sector has been quite resilient, and that's been seen in the underlying indices.
Yeah,
excuse the dog barking in the background.
Yeah, that's your dog, as you're saying. The dog will probably come. Fortunately, I've got a cat, but she's sleeping, and she'll probably carry on sleeping. This is how we roll these days. We do stuff from home. We have dogs and pets at home, and the like. The indices in of themselves. I mean, I was actually looking at for example, the mid cap, and it had done a lot better than I thought. I mean, it was looking at it. It's not shooting the lights out, but let's be clear. I mean, we've got Nasdaq's, S&Ps down way more than double digits. We've got local markets under pressure, and the mid and small cap, particularly the mid cap, has held on.
Well, interestingly, last year was a place where the small caps really shone. They were up just about 51%. From memory, the mid cap about 26, and the all share about 25. I've just pulled the numbers literally as the JSE closed, and as of right now, the all share year to date is down 10.5%. The mid cap is down 6.3%, and surprisingly, the small cap index is hanging on. It's up 0.5%. So on a relative basis, you would have actually made money in the small cap space for the second consecutive year because of its material outperformance to its larger brethren.
And this almost in a sense is Not to disparage the big caps. I mean, they're great, they're wonderful, we can invest in them. But the whole argument behind the small and the mid cap, particularly, I mean, we're talking indices here. If you were talking individual stocks, and we'll get into those in a moment, you're actually going to be doing a whole bunch better. And that's the attraction here, is that, and we don't have to go and find a penny stock. We don't need a Kibo at 4 cents or something like that. We can pick up quality mid and small cap, real quality, and get proper alpha from them.
Absolutely. Again, I love using examples. One stock that's been really in the public perception the last few months. I'll give you 2 examples. Grindrod, the supply chain and logistics company, benefiting from the opening up of the Transnet and Portnet infrastructure to private-public partnerships. That stock you could have bought in November 2020 when I had to buy it at R3.70, and I was laughed out of town when I was presenting on Grindrod at R3.70, saying it had a fantastic roadway ahead of it, and no one wanted to touch it. It's now trading at 11 Rand, having touched 12, and now it's a talk of a town. A second example is HCI, Hoskins Consolidated Investments. It owns Soho Sun. It owns a number of assets in transportation, in coal, in platinum. It was trading at about 80 Rand in early February. And then a small little blog, which I picked up on in the UK, indicated that Total Energy, one of the world's largest oil companies, had hit an oil well off the coast of Namibia, of which HCI, via its spiderweb connections, had a 10% stake in this well called Venus. And the share price went from 80 Rand to 167 in the space of 6 weeks, purely on oil. And HCI is not a small cap. The same is true on Astral Foods, the country's largest poultry company. It's gone from 130 Rand to 208 in the last 90 days.
So bunches of stocks here. Let's quickly sit on Astral. I want to come back to Grindrod, but Astral for a moment, because one of the challenges with Astral, and there are a couple of issues. One is maize, because of course that's an input, and as I understand, maize is a bit weaker, but still well above their sort of the zone which they want, which is what, around 2,400 a ton. And of course, the Minister Patel basically allowing the dumping of chicken back into the market, but as you point out, the stock's done excellently well.
Yeah, Astral's a very interesting case. Whilst Minister Patel has opened the floodgates to potential importing, imports to date, despite the fact that tariffs were applied at a very, very aggressive rate between I think 3% and 265% on a range of European and Brazilian countries, the actual imports in that 6-month window were not that aggressive. In fact, the average imports actually fell like on like. Now, the key thing to Astral, as that chart shows there, is the dramatic surge we've seen in the last 90 days. And that has been pari passu to the domestic maize price, falling from a high of 5,000 Rand a ton down to 4,000 Rand a ton, which means they have operational leverage. Now, if you know that Astral Foods buys 800,000 tons of maize a year and 240,000 tons of soya, every 1,000-ton fall is literally 800 million Rand if you were to do a simplistic calculation. With 45 million shares in issue, you can easily do the mathematics. It's not that simple. But what I'm trying to say is the decline in maize has led the market to believe that Astral has now turned the corner. The trouble is, it hasn't really. Prices are up, but the consumer is under enormous price pressure. We've seen everything go up in the last few months. Fuel, food price inflation, there's no wage growth, there's no employment growth. Most of the country is living on social grants, and it's a fixed amount of money that people have to spend. In Astral's case, yes, it benefited from the maize price falling from 5,000, briefly touching 4. As it stands today, we're at 4,550 Rand average for maize. So it's up 13% from its low. So there will be some margin compression coming in, because at the end of the day, they are very efficient, they're very lean, they are the best operators in poultry in this country. But when you have input costs dominating your life, and with the volatility of input costs, specifically to Astral, Rainbow, and some of the others, you are making good money, but not as much money as you should. So Astral probably needs a maize price of around 2,800 Rand a ton to go back to making what I would call super profits. It'll make fair to good profits at these levels, but the really big numbers come in below 3,000 a ton. And I think for the next few years, given what's going on with Russia, Ukraine, global geopolitics, supply chain issues, and all the issues we know about regarding food security and food transportation globally, I don't see maize in this country going anywhere near 3,000 rand a ton, unless Mr. Putin suddenly says, sorry guys, I'm leaving Ukraine, I'm giving you reparations, I'm friendly again. That's not going to happen anytime soon.
No, that's not going to happen. In fact, and I was chatting with Wandile Schlobo just recently, a mutual friend of ours, and talking to him, you know, we're getting some grain out of Odessa port and the like, but he was largely echoing what you're saying, which is that, yes, prices are off those absolute worst levels, but we're a long way from a sub 3,000. And of course, I mean, there's been times with maize of you know, sub 2,000, 1,500. That is not happening as long as there's a continuing war. And that's not even touching on issues such as, you know, chronic drought. Not so much South Africa, we're doing fine, we got the rainfall, but Europe, and even in those maize growing areas.
Yes, I wrote a note yesterday on soft commodities, and you know, the biggest producer in the world is the United States, and 36% of the corn growing area in the States is currently under drought restrictions, and that's having a significant impact on the potential yield going forward. You've got sanctions against Russia. You've got Ukraine exporting, but so far the quality has been quite poor, and the tonnage leaving the Ukraine has been actually quite low, 1 million tons. Yeah. And they grow about 35 million tons a year. Russia has a 94 million ton wheat harvest, but who wants to touch Russian wheat? So you've got major global producers currently stuck in geopolitics and what I call intercontinental warring politics. And that is keeping elevated prices. And the really interesting thing, which people consistently overlook, is a small thing which we look at in the trade called carryover. Basically, what you've got left over every year, which you put in your stockpile, should times get tough. Globally, for the last 5 consecutive years, the world has actually eaten more than is produced. And where does that difference come from? It comes from stockpiles. So we now have record low global stockpiles. So if there's any significant black swan event in terms of global ecological disasters in the next couple of years, we simply do not have sufficient quantities lying around to meet potential global demand. And that, again, is keeping prices high. And we've now had the 4th consecutive year of fantastic weather in this country. It's been warm but wet. That has to revert at some point back to normality. So we had a 15 million ton harvest this year. The average for 50 years is around 10 or 11 million. So I've been forecasting for the last few months that in 2023, 2024, if we go back to a normalized harvest, there is no way this domestic maize price is coming down. Not a cat's chance in hell. And that's why I'm very, very selective in which food producers I actually want to be in, because Mother Nature and geopolitics is currently driving where food producers are going.
So food producers, I mean, yeah, obviously we've got Astral. I know Libstar, and I got to be honest, when you first tweeted Libstar, it raised both my eyebrows quite a bunch. But Libstar is one of the ones that you quite like.
It is, you know, the share price is trading, I'm looking at my list here, at 5.64 rand. Its low recently was about 4.94 rand, and there's a bit of back history. The company listed in May 2018 at 12.50 rand, and within a matter of months of its listing, it had a profit warning, which is the kiss of death for any new listing. The market took fright and it drove the share price down. It just fell in a heap, and nobody would touch the company because management were basically tainted. But in my universe, having been around for a long, long time and having been trained by some extremely good analysts, you often look past the short-term noise and what could fundamentally change the sentiment and drive for a company if certain levers were to be changed, which would change market perception. Now, in Libstar's case, a change of management would see the old guard who caused the problems replaced by a new guard who perhaps will be, you know, more market-facing and market-friendly. That is basically happening. The former CFO has gone, and I've gone on public records stating that it is my belief that the CEO will retire. Well, he is actually 68, so at some point he will be going to pastures new. We've also got a restructuring of the business. The home care and personal products division was sold. That fell through. It does the likes of washing powders and surface cleaners in the bio-organic range for Woolworths. That's been turned around and doing quite well. But Woolworths as a whole tends to target what I call the middle to upper end market, where discretionary income is not as squeezed as in the middle to the lower market. You know, you and I may go to Woolworths and Checkers and still do our shopping. We may not buy as much, but we're still going to go. And I think that market is where Libstar services, and it's been reasonably resilient. And Libstar has been the only company in the food sector that has actually come out with significantly positive results latterly. In fact, results were so good, the share price ran 11% in one day. And I think on a PE of 6, and I'm forecasting 92 cents for the year, the underlying permutation for this company on restructuring, on new management, corporate activity, a potential restructuring on external management coming in, to me on a 6, you could not buy this company. In fact, private equity should buy this company and delist it. They can't because they already own 38%, which is why John Bickard from Investec, or 91 as it's now called, has been filling his boots with Libstar the last 2 months. He's now got a 5 or 6% shareholding, and Mr. Bickard is nobody's fool.
Yeah, I remember that coming through. Well, what about, so staying with agri for a moment, the maize price, you've created a compelling argument for where maize, be it wheat, I mean, just agri generally, we'll park citrus aside, is going to remain strong. Input costs are hurting, those being fertilizer, diesel, and the like. But this must play well into, I'm thinking particularly sort of the CoOp Agris, and maybe Zeda, although Zeda's a funny one. I honestly not quite sure what's left with Zeda.
Yeah, Zeda is not what I would call now an agricultural company. They sold their AgriVision business this week for 160 million rand, which is the Zambian commercial farming operation, which has been a complete and utter dog for years. They've probably lost £500 million rand. And what's left is a stake in Capespan, a majority in Capespan, and a seeds business called Zod, both unlisted. So I park Zeda now in the been there, done that. Why are you still listed? Okay. Just pack up your bags and just go away. The real main agricultural plays are JSE listed CoOp Agri trading at 38 rand. You've got TWK on the Cape Town Stock Exchange at about 50. You've got Senbez on the OTC at about 14 rand. Then BKB also on the Cape Town Stock Exchange trading at about 11. So the big daddy is CoOp Agri. It's well known, it's liquid. It's been through its own liquidity event where Zeda unbundled its stake, putting pressure on the share price. That little dip you've seen there in the graph is basically the liquidity event of Zeda unbundling its stake. And then we have another liquidity event coming up where the stake that PSG got in CoOp Agri will also be unbundled. So they've come out latterly with a really, really solid trading update. I went out to the market in late July, indicating that I was forecasting between 535 and 550 cents for their September year end. And they came up with a trading update a couple of days ago. Literally, I was literally in the ballpark, as I would say, and the share price has run up quite nicely. Even at 38 rand where it is today, the compelling valuation remains. But I would wait for the liquidity event of PSG to have the market awash with shares. You'll have many clients, many institutions saying, what the hell is this thing? We don't want it, we don't understand it, what does it do? And naturally they just exit the stock. So I would lay a very good case right now. If CoOp Agri would trade between 35 and 38 rand, I would happily buy that stock on a 2 to 3 year view. My target price is 64 rand. It's one of my top personal shareholdings. I've owned the stock since 7 rand 30, and I'm not a seller. And if a bid ever comes along for that stock, it ain't going to be at 38 rand. Particularly right now, if I get my calculator out based on my forecast earnings for next year, it's on a PE of 5.8. You cannot get a quality company like this for a 5.8.
Yeah, I agreed on that. You mentioned TWK, and I've chatted with them a couple of times more recently, and then also chatted with Cap Industrial because they're PG Bison, and their PG Bison business has been doing great guns. They added capacity and they're at 100%. They've got more capacity coming, and that started me thinking, well, what about TWK? What about York? Because TWK has got a big timber division, and of course York is timber. Is there something there perhaps? I know you like York, certainly on a corporate action sort of value unlocked type of story, but if we're seeing PG Bison with strong demand and going through, their new production I think is mid-2024, and it's going to add about a third to their capacity, the timber manufacturers, by my simple logic, surely should be smiling.
Yeah, you raise an extremely valid point. I cover TWK and York. I actually own both shares in quite some size in my personal portfolio. And in TWK's case, you could have bought that stock a year and a half ago, 28 rand. It's now trading at 50. And you're right, it has significant forestry interests. It supplies the mining industry and the construction industry. But its main arm via Richards Bay is it has the capacity to export 900,000 tons a year of wood chips. And when I tell people, they say, wood chips, why do we care about wood chips? I said, because paper is made out of wood chips and pulp. So they're exporting, cheap product in this country to the Asian paper and pulp market. We've got the rand as it stands right now. It's at 17. What are we at? 17 rand 30. It's down 18% since April. So as an exporter of product, they're coining it not just on a global demand for wood-based products and the rise in paper prices. You've also got the rand in their favor. Novus Holdings told me at their AGM last Friday that global newsprint prices are up 50% year on year. So paper and pulp businesses are doing fantastically well. So if you're supplying that market in an export environment and you're growing the stuff yourself, chipping it and exporting it, you can make a great deal of money. And I've gone on record saying that TWK's August final results will shoot the lights out, probably be the best result they'll ever have in their history. And the same should carry on into next year. In York's case, they were doing really, really well. They managed to extricate some of the old crusty board to bring a better management structure in play. And then a nasty strike happened. And the plant was basically shut down. It got quite violent. There was some activism and they lost quite a few months of production. And as such, the York share price has unwound to £2.51 from around £4, purely because the market now sees that this year's earnings are basically a write-off. I actually spoke to one of the activists who own 20% of York last week, and the strike is basically over. They are recovering. There's significantly strong demand. There's operational leverage. There are levers that can be pulled to make a plant more efficient and more profitable. And I think York's time will come. It's just we had a speed bump in the last 12 months in exiting what I would call the old crusty management, which held the company back for 10 years, and of course the strike. So 251, York is a company that I like, but it's just now been delayed by a year because of factors beyond its control.
Yeah, I take your point on that, and that's always going to be a risk out there. A question coming from Eugene. He's asking, what about commodity companies? And he mentions Jubilee, DRD, Orion. From what I understand, Anthony, the only sort of commodity company, apart from the agri, and we'll park that aside, is Renogen. And of course, they're not a mining company; they're an energy company, or in a sense.
See, I'm just a simple ex-engineer. So I cover the stocks that I've covered for many, many years, and I leave the what I would call the resources sector to my clever associates and counterparts who actually are geologists by training or mining engineers. So I have no credibility in that field, because the second I start talking about a really deep level mining company like Orion, Jubilee, Novum, Impala, Amplats, Sibania, I have no credibility. I cover Afrimat because I've been covering that stock since 2006 when it listed as a construction materials company. It's now diversified. Renogen is an energy play in the gas field, which I've covered again for the last 2 years. But on the smaller commodity type stocks, I simply do not get involved. One, because it's not my area of expertise, and secondly, I'm simply not that clever.
I want to come back to Renogen, but a question which has pondered me. How do you select? I mean, there's a universe of stocks, and that universe is maybe 100, 150 JSE listed potential stocks that you could cover. Some of them, like you say, the miners, I'll leave that to the geologists, and the smart oaks makes sense. How do you decide which is a company that you will cover? I mean, because obviously the list changes, although from my interactions with you over a decade and a half, it's fairly consistent, but new ones come in from time to time. Renogen didn't exist a decade ago. How do you decide one day that, hey, this is a company perhaps I should be covering? Because of course, and we've seen the photos on Twitter, out comes the folder, a whole process starts. And it's not like me going and looking at a chart. I mean, you do real digging, you chat with management and fly around the country, go see Combined Motor up in Umhlanga and the like.
Well, as an example, I've just booked my ticket right now to go and see Afrimat's Jenkins and iron ore operations in Sishen in October. And that airfare alone, just to go and see a site, was 10,000 rand. At the end of the day, an analyst that covers the sector has to get off his arse and actually go kick the tires. And the only way to understand what is going on at a company is literally, get away from the balance sheet and physically go and see the operating assets and speak to the people that actually, are working on the ground. And I do that consistently. I tell people, if you don't speak to a company a day, and I speak to one, sometimes more a day, then you as an analyst, lack credibility. An analyst is not driven by the decimal point in an Excel spreadsheet. I can't even use Excel. As I said to you earlier, I work on, on old-fashioned files like this, where you start building a picture of a company. And to go back to your question, how do I select a new company? I generally pick up about 4 new companies a year. And I was asked yesterday, but Anthony, how on earth do you keep busy? You're an independent analyst servicing the institutional market. Surely you have no work to do. And I said, I have never been busier in my entire career, despite only having 288 stocks in the JSE compared to the over 800 I had when I joined the market back in 1996. So yes, there's been delistings. Yes, there's been acquisitions. But many of the stocks in my universe, remember, are not covered. And in many cases, as corporate activity or some form of shift in the operational change occurs, it suddenly rings a little bell in my mind saying, well, I've been keeping an eye on this stock for a number of years, but it wasn't worthy of coverage. Now something is beginning to happen which could, in my mind, change investor perception and sentiment towards the company, and as such, its share price. So this year I picked up Master Drilling, I picked up CANS, I picked up Coca-Cola Bottling, which the listing was delayed, and I picked up Deneb, and there's one other who escapes me. None of these were on my radar a few years ago, but as things start to evolve, they suddenly start saying, well, that looks interesting, you know. And as the story starts to unfold, and I generally get to see it first because I kick the tires and meet with management, it then starts, you know, it's like a snowball. More people suddenly get involved, and the snowball gets larger and larger. And by the time it's like the size to make a snowman, the easy money has been made. I try and catch things when they're the size of a snowflake. And as a direct example, I'll tell you about Renogen. Now, for many, many years, Renogen was a stock on my horizon, but I refused to cover it. Not because I didn't like the stock, but as you see in the chart there, you'll see for quite some time, it traded around the 10, 11 Rand range. I'm going back to the start of your chart there. Nothing was going on, because it was an exploration company which needed to prove that what it had in the ground was actually in the ground, was commercially viable, and could be exploited. And I needed to wait for that point to actually start covering the stock, moving away from what I would call a speculative exploration stock to one which had commerciality. That, to me, happened November to December 2020. When, having had a conversation with Steph Marani, it was clearly evident in my investigations and the work that I did. And I've seen the operation now 4 times. I think I'm the only analyst to see the operation on 4 consecutive site visits over the last 2 years. So I've seen the evolution, and that then gives you comfort when you see, you know, what is basically a piece of dirt. Then it has a piece of dirt with a couple of wells, then a piece of dirt with more wells and pipelines, then a piece of dirt with wells, pipelines, and an operating plant, and then latterly a complete operating plant. You can see that there's an evolution there to commerciality. And Renogen, as you see from a run up there, has proven itself to be a world-class deposit in terms of LNG and helium. I just happened to catch it as it started to run up around 11 and 12 Rand, because I've been waiting for that spark to catch the market's attention. And that's when I got in.
And that is always the point, is that there needs to be that change of sentiment. And, you know, often it might not just be that you're a well-run, profitable company. I can see him just does me there. You might be a well-run, profitable company, but you need the market to change its view on you. Without the market, truthfully, nothing else really matters. It's the market, that snowball you talk about.
Yeah, exactly. At the end of the day, you know, as a small cap company, you know, you tend to raise money from a handful of individuals initially. Be it some select institutions or private backers. And then when you get to a certain scale, you actually need to get institutions involved to actually raise the capital needed to actually take a project to feasibility or commerciality. And Renogen was not that well followed for a number of years. It only had a handful of investors. Marzi Capital was one, Sanlam was another. And as the prospect starts, you know, gaining the attention of the market, more institutions come on board. You know, it then catches the attention of what I would call the private client market, who generally, sadly, get in too late. You know, as the stock is running, they suddenly get very excited. Oh, come here, boy. Come here. Come here. Oh, yeah.
Yeah, he wants to lap in. There we go.
There. You know, and by the time the private client market gets involved, you know, the real easy money has been made, and they're caught up in the snowball. So one of the things that I try and educate the private client market is you do not have a disadvantage to the institutional market. In fact, you have an advantage, because you can spot things faster and quicker and move more nimbly. You just have to be very well informed and perhaps, you know, read and educate yourself a little bit more, because by the time the institutions get involved, the easy money has generally been made. And again, a classic example is Grindrod. Nobody wanted to touch this stock when it was 3 and 4 rand. Some of the smaller hedge funds did, some of my smaller clients did. When the stock hits 9 or 10 rand, the major institutions are involved because they now see the story unfolding. But you've lost 100%.
Yeah, you've given up that first initial meaty part of the move. Quickly back to Renogen. Phase 1 is rolling. The key point was they need all that money for phase 2, and from my understanding, Steph can pick and choose. It's a beauty parade. The Ivanhoe extra didn't happen. That's not a bad thing, I don't think, because frankly, for what he needs, he's got more being offered to him than what he needs for phase 2.
Yeah, again, my view on Renogen has been well documented in the press, the notes that I've written, and of course my commentary I've made in the Financial Mail. And I'm of the view that there's an embarrassment of riches out there to fund a globally commercial deposit of helium. There's $500 million coming in from the DFC, which is an American-backed fund. There's $200 million from other banking sources, and I think again, as I've gone on public record, Renogen has denied it, but they can't really say a great deal for obvious reasons. But I'm of the view that at some point this stock will list in the US market. Montauk has been extremely successful converting waste gas into energy, and the share price, as you know, has rocketed. And the Americans understand alternative energy. And I would think, again, as I've written consistently since the start of this year, I would not be surprised if in the early quarter of next year, we see Renogen listed on the NASDAQ market, and then a whole new universe opens up where this company is no longer seen as a small speculative play, on the arse end of Africa. It's seen as a world-class deposit with great assets, with a long pipeline, and then what I would call the serious money starts getting involved. And we've got Virginia Phase 1, which is on the go. Virginia Phase 2 will be up and running by 2025, and they're even talking about Virginia Phase 3. So the underlying size of that prospect, I think, will astonish many people. They've had one competent person's report put out by the Canadian company Spur, which was significant regarding the underlying reserve and resource. And it would not surprise me if in due course a second revision were to come out saying, well, we've explored more of this 187,000 hectares, and by the way, we've just found some more. So I think Renogen, without sounding like a snake oil salesman, which I certainly do not want to be, is the stock which I think will keep on giving. However, you do not have a share price running as hard as you've seen there without some natural correction. We've been around a long time. I've been covering markets now for the best part of 40 years for myself. And when I see a stock that's gone from 11 rands to 44, we're now back to about 33. The interest is there, and it may drift a bit lower, maybe to the to the late 20s, early 30s. But the underlying prospect of this company going forward on a longer term perspective remains as solid now as it was at 11 rand. You just have to be mindful of the volatility and the market environment we are currently playing in. And the private client market needs to hold their nerve. If you bought this stock for the longer term, then hang on for the longer term. You must not look at the daily volatility in the share price. Otherwise, you should not be in this specific stock.
Well, you should stay away from small caps, focus on the business. But I take your point in listing, because Steph has more than once in public forums too basically said, you know what, these asset managers in South Africa are useless. They don't give us money. I think you're right. I can see a NASDAQ listing most certainly. But to that point, I look at my stocks all the time because it's what I do, and I'm a screen gazer and that sort of thing. But I don't let the share price dictate what I think about the business. The share price is what other people think. Renogen, I think I got it at about 16 on my first pick, maybe 18, around that point, and then the run and the pullback now. And I get the tweets and I get the emails. What's happening? Should we panic? And it's like, as you say, Anthony, something that goes up 4x in double quick time, it's going to have the pullback. And we're not looking to buy this and sell it in 6 months. We're looking to buy this and sell it many years down the line, and perhaps with extra zeros to it. And we need to look through the price and say, you know what, that's just volatility. It's what markets do. The story is what really, really matters.
Yeah, you're right. The story does resonate with what the world wants currently in terms of cleaner energy and, of course, the global demand for helium. And from my perspective, when I'm looking at a stock, I'm not looking for the next, the next 1 or 2 years. I'm looking for, in many cases, a decade ahead. And in Renogen's case, at some point, and I've laid this case out again in work that I've done, the real cash crunch will come probably 2024, when it needs to raise all the money to fund Virginia Phase 2. Once the operation is up and running at full pelt in mid-2025, by 2026, this company is probably going to be making, in theory, 3 billion rand a year of EBITDA, which means the 12 billion rand of debt that it has will quickly be repaid from cash flow. The underlying running cost of Renogen at that point will be 800 million rand a year. So there will be significant free cash flow to actually repay debt. And as debt starts to come down, what you naturally do with excess cash, you give it back in the form of enormous dividends, or perhaps you fund Virginia Phase 3. So I'm looking from 2026 onwards, which might seem like a long distant timeline, but it's only 4 years away. Am I prepared to wait 4 or 5 years for a company which could, in theory, in my pension fund, be paying me significant dividends and hopefully capital appreciation? I'm going to sit here and say, you know what? I will live with volatility for what could happen in the next few years.
Yeah, the volatility is neither here nor there. There's quickly a couple of folks are talking around Afrimat. This has been an amazing story. I still think that Andries van Heerden and his team probably the best capital allocators / deal makers on the JSE. The magnesium mine project cancelled, but they've raised a whole bunch of cash for it. Of course, iron ore also under some pressure. But again, this is a stock. This is less around the share price. This is more around the story behind it and the incredible good assets that they've got.
Yeah, Afrimat, they had a pre-closed investor day last week, which I listened into. And I've covered the stock since its IPO back in 2006, when it was nothing more than an aggregates and gravel business. It's now involved in 11 different minerals, the largest being iron ore, which is the dominant part of its profit profile. And the manganese side, as you say, would have been a substantial greenfield operations in the Kalahari, probably costing between 1.2 and 1.5 billion rand. But sadly, the Department of Water just didn't grant a sufficient water license to make the mine viable. I'm not giving too much away, but you cannot mine a substantial mine with a 1% water allocation. It is complete madness. So the Department of Water basically, put the kibosh on what would have been a major revenue generator for a very poor region, significant job creation, and of course a profit spinner for Afrimat, and a contributor to the fiscus in terms of exports. That's now gone. Regarding the money that they raised, which was the offer was basically oversubscribed. The share price, as I'm looking right now, is back to 50.19 rand, so it's at a discount to the placement. I think the key thing to Afrimat is it's got great prospects. It's got a management who are astute capital allocators. I'm looking at some numbers here right now. Many people may not realize that since the middle of April, the rand has weakened by 18.6% against the dollar. In the same period, the iron ore price has gone from $161 a ton to 104. So if you do the rand dollar conversion, the rand price of iron ore per ton has gone from 2,360 to 1,810, which is a drop of 23% in the last 3 months. Now, if you're someone like Kumba, which is now trading at a 52-week low, or someone like Afrimat, also trading near its lows, where a significant proportion of your money is coming from iron ore, you cannot replace the quantum of money that you have lost from a decline in iron ore from other products. In Kumba's case, it's only iron ore, so they've been nailed a lot more than Afrimat. I think Kumba year to date is down about 50%, and Afrimat's probably down about 20%, because it has a basket of diversification. So if I had to be in any commodity stock for the longer term, it would still be in Afrimat. The Unkamadi coal operation is going to be expanded. The Glenova phosphates and rare earth minerals has prospects. And again, I've gone on record, and it was mentioned in the presentation last week, the money raised certainly will not burn a hole in management's pockets. They will just accelerate the expansion in coal, in phosphates and rare earths. And those are the exciting things. Coal may be dirty and unfashionable, but the world needs coal to generate the electricity to keep the economy going. We can all dream about having solar power and wind and Tesla cars in our garages. It ain't going to happen anytime soon. We're going to need coal and oil for many, many years to come. And on the phosphate side, the demand for fertilizers will remain aggressive, and then rare earths. extracting the metals used to make batteries for electric cars. Who does not want to be in that area? So Afrimat made 50 Rand. Yes, it's down in its luck because of the iron ore price. But at the end of the day, it's had a great run. Would I use weakness to buy the stock? Absolutely. I own it myself. It's been one of my core holdings for many, many years. But I'm cognizant of the fact that it is very aligned to iron ore. And until they start to further diversify their base, it will be the risk going forward. Manganese would have alleviated that risk in 2024, but right now it's still an iron ore play.
Yeah, and they got a cash pile, and as I said, Andries would do something smart with it. Let's switch tack completely. Motor vehicles, Motors, combined motor holding. They obviously struggled a lot. They just couldn't sell cars during hard lockdown. Then they couldn't get cars because of chip shortages. We're seeing that slowly starting to sort of work its way out of the system. If memory serves, I think combined is your preferred, or am I wrong in that?
Yeah, it is. The Motors results came out, I think it was yesterday or the day before. They were astonishingly good. It's a big company. It's basically a spin-off from the old Imperial, Bill Lynch's company, for those who know who Bill Lynch is. You and I do. So Motors had a fantastic set of numbers. It's got operations in Australia, in the UK, and in this country. But it's a large company. I prefer Combined Motor Holdings, which is a smaller business worth about 2 billion Rand. Run by a very astute old motor dealer in Durban called Jeb McIntosh, who's been around literally for the last 50 years and knows nothing about selling cars. You can teach a 76-year-old. He's been doing it for longer than the two of us have been alive. And he runs a very, very astute business. And they literally cut costs to the bone during the pandemic. And because they tend to sell cars in what is, the more affordable end of the market. Yes, they've got a few Lexuses lying around and a few Jaguar Land Rovers, but the bulk of their sales in Suzuki, Ford, Mazda, Nissan, Haval, Chery. People are trading down because of the economy. So some of the other motor retailers who sell the higher end marques, Mercedes, BMWs, etc., are struggling because one, you can't get the cars. Two, people aren't buying as fancy cars as they used to because of the economy. And they're looking for more affordable vehicles, which is where Combined Motor Holdings comes into its own. The last NAMSA stats, which came out, I think, last month, Suzuki, which is a CMH brand, they own the franchise rights, was the second best-selling brand in this country after Toyota. Now, if you'd have told anybody 5 years ago that Suzuki would be the second best-selling car in this country after Toyota, they would have laughed at you. But people want value. They want a good car with a good warranty, with good products, which is reliable for an affordable price. The same is true with Haval, Chery, Great Wall Motors, etc. And in Combined Motor Holdings case, they also have got First Car Rental, which because of the pandemic, many other car rental companies went to the wall. Avis basically, that's been for sale for years. It hasn't happened. Bidvest moved out of the business. Many other companies really cut back their fleets and slashed their operations. Whereas First Car Rental did a deal with Safair, the only airline that kept flying when everybody else went bust, and they now have a significant market share. And as the economy reopened, tourists came in, and what do they want? They wanted car rental. When there's more demand than supply, average vehicle rates go through the roof, and they've doubled in a year. Anyone that's rented a car in this country in the last 2 months will realize how much car rental rates have gone up. And they've made a great deal of money on car rental, on selling more affordable cars, and then on spares, maintenance, and services. People need to get these cars maintained. And on a PE of just under 6, with a cash pile of 800 million Rand, which is 45% of its current market value, why would you not want to be in a small company where if you strip out the cash, you can buy this thing probably at a P of 3.5? It makes astonishing sense. And as I tweeted yesterday, if Motors is up this good, it was up 70% in terms of earnings, you can damn well be sure that CMH will be as good. And it's sitting there in a PE of around 6. Whereas Motors, I think, is in a 9 or a 10.
And I can attest, I mean, before the pandemic, sometimes when I would fly and do a short trip, it was cheaper to hire a car than an Uber, and that just made no sense. And that is not the case. And as for Suzuki, I know somebody bought a Jimny recently, and there was a wait list. The wait list wasn't because they couldn't get them. Well, they couldn't, but the wait list was because of demand. There were just so many people who particularly wanted and were just desperate for it. It's a great stock. I hold it, and yeah, they've just, Jeb is he's car salesman to his core of his DNA. What about the Omnias and Victors of the world? Omnia just paid a massive dividend that's brought some of the share price back. We've seen this with a bunch of the shares where there's, I suppose, some pressure in it from sort of the massive heydays which they were having. But certainly there's still a compelling story here, and particularly, if we're looking at fertilizer providers and we're thinking about the agri guys we were talking earlier, your point around maize, staying at 4,000 plus, there's opportunity here, surely.
Yeah, at the end of the day, when you look at certain types of companies, you just can't look at the underlying product that they actually produce. In Omnia's case, everything is based around phosphates and ammonia, which goes either into fertilizer or into explosives. So they basically service the agricultural and the mining industry, all from the same base product. So you have to have a look at what's going on internationally. Now, anyone who follows international gas prices in terms of physical natural gas will follow three main markets: Japan, the Dutch wholesale gas market, and the US NYMEX. They've all had huge runs in natural gas because of what's going on with Russia and Ukraine, and Russia using gas into Europe as a weapon to try and stave off further sanctions. We've seen natural gas prices into Europe go through the roof. I tweeted a comment literally before we came on air from a source of mine that I follow, that 70% of the ammonia plants in Europe are currently shutting down because the underlying input, which is gas, is so expensive that they simply cannot make any money. Now, when you start shutting down plants, it's typical, guns and butter economics, supply and demand. People will still plant the crops, they still need fertilizer, we still have to eat. But the supply isn't there, prices naturally run. So if you're someone like Omnia in the fertilizer market, where you have your own ammonia plant, yes, you import, but you also can produce your own product, you're going to be somewhat insulated. And the key thing that the market has failed to recognize in Omnia, and it's a stock that I own myself, and I have done for many, many years, is one, it is now extremely cash generative. They've paid back 14 Rand in the last 2 years in special dividends. And those of long memories, seeing the dip in your chart there, 20 Rand, was when they had their rights issue to bail the company out when it was on the verge of literally being rescued by the banks. They had a 2 billion Rand rights issue at 20 Rand, and the new CEO, Seelan Golbani, went on public record saying, I will give you back the market, the 20 Rand you gave me in rights as a thank you for your support. So far, we've got back 14 Rand. There's 6 more to come. And I'm convinced there's more special dividends to come in the next year or two. And in the fertilizer case, whilst international fertilizer prices have come down, they're only off 11% from their highs. They're still up 80% year on year. So whilst the base has come down, on a year-on-year level, they still remain extremely wide. If anybody thinks that Omnia is going to see a crashing fall in its profitability for fertilizer, excuse me, they are deluded. They're still going to make very, very good money. And given I cover the agricultural sector very, very closely because of the work that I do in soft commodities, I can tell you in feedback that I've got from the farming sector, they'll be planting this year as much as they did last year. I'm forecasting another 15 million ton crop of maize, an even bigger crop of soya and sunflower, because international prices are firm. If you're growing more, you use more land, you need more fertilizer. Fertilizer demand is not going to fall off overnight.
And you make a great point there, Anthony. It kind of ties in with Afrimat as well. Yes, fertilizer's down. Yes, iron ore is down. But make no mistake, these companies are still making super profits, maybe a little less super than the previous period. But don't take any shine off it. These companies are almost cash printing machines, even at current sort of slightly lower underlying commodity levels.
Yes, I love using the term, but back in the heyday of a year ago, the likes of Omnia and Afrimat were making, and even Kumba, making what I would call obscene profits. The typical sort of windfall super profits. They're now just making spectacular profits.
Okay, and we can live with spectacular. Let's go completely different. Let's go to Spur. I got to say, I don't have kids, so I haven't been to a Spur in, I don't know, forever and a day, but I thought those results were really good. I think the business is looking good, and there's opportunity here to get their margins sort of back to pre-COVID, which can really help and boost some profits on the bottom line.
Yeah, the results were really good. I spoke to Val Nichols, the CEO, literally late last week, and I go to the Spur, not because I'm a Spur goer, but I babysit for the other half's nieces and nephews.
There we go.
Where do you take young kids? You take them to the Spur. They can go and kill themselves in a playpen, and you can have a beer and a burger in hopefully some peace and quiet. And interestingly, during load shedding, given that most of the Spurs tend to be in areas where there's a generator or they have some form of power backup, if you suddenly are hit by load shedding and you have to feed the family, where are you going to go? You're going to go to a Spur, and they've done remarkably well due to load shedding. Yes, input costs have hit them because the cost of imported flour for pizza dough and imported tomatoes for bases, fish has gone up, beef has gone up, etc., etc. But they've managed to contain their menu pricing quite nicely. And at the end of the day, Spur has reinvented itself. It's still the same classic business that we've known since the early 70s. But the consumer that goes to the Spur, without sounding snobbish, isn't the likes of a you and me. It's the middle to the slightly lower market who want to go out and enjoy themselves and have a good time with their families, with their partners or their children, and feel they've had a good meal at an affordable price and then go home happy. You're not going to go there for a gourmet slap-up meal. If you want to do that, you go to Hazard's Grove, which is also owned by Spur, which is doing fantastically well. So I think in Spur's case, I can see some margin expansion coming there. And the key to this business going forward will be paring costs and targeting that niche market, which wants to eat out on an affordable basis in a family-friendly environment. And if load shedding were to ever end and any form of growth were to come back to this economy, Spur, I think, would do extremely well. They sit on net cash, unlike famous brands. They pay good dividends, unlike famous brands. They have a great track record of not buying businesses which suddenly go belly up, unlike famous brands. And at the end of the day, it's a smaller, more nimble company. It might seem conservative, it might seem slightly dated, but you know what? In this environment, in this economy, in this consumer spending environment, I will take conservative and staid over large and debt-laden any day of the week.
Agreed. And the distinction between famous brands and Spur, and the one went off to the UK and bought a gourmet burger kitchen for what, 2 billion and wrote it down to zero. And the other bought a little Rockamama's and turned it into a great band. And that just perfectly sums up the distinction between the two. Anthony, we're hitting our time, so I want to throw a last question at you, which is the open-end one. Is there a stock which we haven't touched on this evening, which when you were prepping, you were like, this is an important one we need to talk on, either for good or bad reason, that perhaps one we dismissed?
Maybe I'll be cheeky. So this is my working file of a company that I've covered for 15 years. And if you can see it there, it says Kuro Holdings.
Kuro.
Now, people think I may be mad in recommending this stock, but sometimes a stock is beaten down for a reason. I first covered Kuro when PSG bought the stock 15 years ago for 15 million rand for a 50% stake. And at one point, the market value of Kuro at its peak was 20 billion rand. We're now back to a lot less than that, probably about 4 or 5, 6 billion rand. And the share price, as I speak, is trading at 10 rand 44. They had really good interim results which came out. I think the numbers were up about 34, 35%. And the reason why the share price is under the whip is for one simple reason: the PSG liquidity event. PSG, in its unbundling and its buyback, has decided to basically get rid of everything that it doesn't want to keep for itself. And for some anomalous reason, PSG is exiting their entire 64% stake in Kuro Holdings. So 380 million shares will be hitting the market in the next few weeks, the next couple of months. Now, if you think of it logically, if you're a fund manager and you suddenly end up getting a massive pool of Kuro Holdings, you're going to say, I don't want this. I'm in Avatech, or I don't want to be in education. The market's going to be flooded with stock. There's going to be an extreme liquidity event. So I'm waiting for this liquidity event to maybe push the share price down below 10, because I have an earnings forecast this year of 53 cents, which is a good gain in last year's 40. It still means the stock is trading on a P of around 18 to 20, which isn't exactly cheap. But I've got a particular view that in the next 2 years, at peak capex in 2023, by 2024, this company will be paying back debt. It's already cash flow positive, generating significant working capital to fund itself. it'll at some stage, a bit like Renogen, start producing so much free cash flow. It'll start repaying debt and giving me strong dividends. That is now 2 years away. So if I can see a liquidity event pushing down the share price in a company whose earnings I can see going from 53 cents this year to I've got about around 50 by 2024, 2025, on a 10 Rand 44 share price with debt coming down and dividends being paid, to me that sounds like a very compelling story. Now, I cover the entire education sector, Advotech, Stadio, and Kuro. And for the last 2 years, I've had Advotech as my #1 buy, Stadio as my #2, and Kuro as #3, must try harder, you're not your just pet. In September, after the liquidity event, which is now, I'm putting Kuro as my #1 stock, but not yet. You've got to wait for the stock to be nailed with a liquidity event. If I could pick the stock up under 10 Rand, I would sit on it for 12 to 18 months, and I've got a target price of 16 Rand. Now, the reason why I say I choose Kuro, get my little calculator out here. Let's pick some easy numbers. So I can see a 60 to 70% capital increase in Kuro if I'm right in the next 12 to 18 months. I do not dislike Advotech. I had lunch with them yesterday in Cape Town. Fantastic story. But do I see Advotech and Stadio running by 60 or 70% in the next 12 to 18 months? No, I don't. My single role as an institutional analyst is to make money-making ideas for my clients. The best money-making idea right now in the education space in Kuro, and one of my top sector buys in the small to mid-cap space is Kuro Holdings, but only at a certain price point because of a liquidity event. So between 9 and 10, if I can pick it up at that level, I think I can make between 60 and 70% on 18 months. I will take that any day of the week. Even if I'm wrong and it gets to 14, I'm still at 50%.
Yeah, no, I agree 100%. And that liquidity event is so critically important. You mentioned it, CoOp Agri as well. Stock coming to the market, folks are going to get it and they're going to be like, I don't know what to do. And you can just see it across the different shares that happens to, either as an unbundling or as a stock that's already listing. Quick last one, and then we will call it. A couple of folks asking about Grindrod. This was your pick, if I'm remembering correctly, 2 years ago, if I remember, and again last year when we were on air. It's now run. It's now at 10.50. Is the party over for Grindrod?
The answer is yes and no. As I said to you at the start of this preamble, I like to get involved in stocks before the easy money can be made. And It was November 2020 when I had a buy in Grindrod at 3 Rand 54 and at 3 Rand 70. And it's all well documented. And I couldn't give the stock away. In fact, I had one institution chase me out of their office saying, "Don't you be bringing me this stuff." But again, certain things have to evolve in a company's life in order for value to be unlocked. In Grindrod's case, it was stuff full of debt. They had assets to sell off, like a bank, like the land, like a private equity portfolio. And as that has unbundled and actually been sold off, the market suddenly seen, oh, look, they've just raised 2.5 billion Rand by selling off assets. Now that's basically worth the current market value of a company. And they still have a very interesting rail and port operation. They have a fantastic logistics operation in Mozambique with ports in Matola and Maputo, which are growing extremely fast because of a disaster, which is PortNet in this country and Transnet. The bank was sold for 1.5 billion Rand to African Bank, which is double the market valuation that they thought it would get. Debt is rapidly being paid, and the share price is running. And then we come out with a government saying we're going to get involved with third-party rail and potential private-public partnerships in the ports. And who is the only person who's got rail expertise, port expertise, and physical assets operating right now? Grindrod. So I see Grindrod as either being a takeout target, should Rembrandt want to partner with MSC to buy it, or at some point putting in capital to participate in the public-private partnership. So my real excitement for Grindrod, the easy money has been made. It's gone from 3 Rand 50 to a high of 12 Rand. We're now back, as I speak, to 10 Rand 53. But natural pullback had to happen. Nothing goes up in a straight line. I would not be chasing the stock at these levels, but if I saw the stock back at 950, which is a natural sort of retracement, you know, things go up sharply and they fall a third on the way down, then they take off again. I would want to be involved in Grindrod in the longer term. Every single one of my price targets has been met, including a recent one of 11.50. My current price target is 14 Rand. So I'm saying again, Grindrod is one of those stocks that the easy money has been made, but you can still look to participate for the next leg up when the rail infrastructure and the port infrastructure starts unfolding in the next 2 or 3 years. So yes, it's a great stock, but it'll get even better, but the easy money has been made.
And I take your point. When Remgro and MS Mediterranean Shipping Company, they bought Mediclinic, and I'm like, guys, you're buying the wrong asset. I really thought they were going to, and I think they still might. I mean, Mediclinic's a big pill to swallow, but I do think, and of course, we've seen Grindrod Shipping now under offer, which was spun out recently. Folks, we're going to leave it there. We have hit our time. We promised Anthony would only take an hour of his time. I appreciate everyone coming through this evening. Anthony, I appreciate your time this evening. Absolute legend. We learn a ton every time you do these power hours for us. Really, really do appreciate. All the best.
Thank you, Simon. Take care.
Ladies and gents, take care, look after yourself, and as always, if you can, look after someone else as well. We're back again at the end of the month, and I'm trying to remember the date. I think it's 29 September. We're going to be looking at listed property. It's been beaten down. It's at a horror show. Office, who goes back to the office? But maybe there's something there. We'll dig into that. Everyone, stay safe, and as I said, look after yourself. Cheers all. Anthony, really appreciate it. Thanks all.
Take care. Thank you so much.
That was brilliant, gent. Always.
Happy to help.
Cool. You go play with your dog, who definitely was feeling unloved for there a bit. All the best, man.
He gets fed at 5:30, and sadly, you took his din-dins away.
Oh, then it's my fault. Cheers, man.
Take care, Simon.
Cheers.
Bye.
Gets fed at 5:30 at the webcast start.